Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis. In today's edition, we're going to be discussing scalping with a 5-minute time frame. The methodology in this presentation is to use the 5-minute time frame of the Euro-USD and the GBP-USD pairs during the lulls in the market. Such lulls or quiet periods tend to occur after the American session and just before the Asians come to the market. During the Asian market sessions, traders typically tend to focus on domestic currencies that affect their own currency's GDP, such as the yen and Australian and New Zealand dollar. Therefore, if the timing is correct, opportunities will present themselves to scalp, or look for trades with expectations of only making or losing a few pips at the time in this type of scenario. Should trades spill over to the Asian session, financial institutions will be taking positions with our peers and volatility will increase, but our technical analysis setup and tight stop loss should protect us from heavy losses. And although the present market conditions are extremely volatile due to the coronavirus, eventually the markets will calm down and opportunities will present themselves to try and make money in calmer markets with this methodology. The first part of our setup is to observe periods in trading that have not been volatile in the run-up to the closing of the American session. We are looking for periods of consolidation and sideways trading in our two pairs, which should spill over to the twilight zone between the American session closing and the Asian session opening. We want to keep our chart set up to a minimum with as little indicators as possible because they tend to be quite laggy on the 5-minute chart. Price action and Bollinger Bands are the key behind this setup. Example A shows the GBP-USD pair on a 5-minute chart, and the period of our two vertical lines shows the time zone we are targeting specifically. Please note that some brokers use different times on their charts such as ours, which is 2 hours ahead of UK time. First of all, we can see that price action has been very muted in the run-up to the time we are focused on, and should this be the case, there is no reason why you should not enter this trading methodology sooner, should you wish. In example B, we have added the Bollinger Bands with a period of 13 and deviation set to the standard default of 2.0. The most critical part of this setup is the bands must be moving sideways. In example C, we can see that price action spikes outside of the band at position A, where we have gone short and placed a tight stop loss a couple of pips above the previous high as denoted by our horizontal line. And where price action touches the bottom of the Bollinger Bands, we need to exit the trade. If price begins to move higher inside the band, which it does at position C, we would enter a buy trade with a target of the upper band and with a stop loss a couple of pips below any low in this consolidation period, in which case our exit position would be D. There are conservatively 15 pips within our highlighted period and a total of 50 pips within this consolidation period as presented on the chart as price moves from the top and bottom of the bands. Tight stops keep losses to a minimum with this setup, and it is ideal for trading this time frame. If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.